Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 31st, 2013 edition of Market Outlook. Please be sure to sign up for this newsletter at www.marketgauge.com, and you get it free every week. So we had quite the quarter, market up over 10%, and let's drill down into see what we have and what the market's telling us right now. So overall, taking a look at the bigger trend or the daily trend here, the Dow is clearly basically closing on just about new highs, and more importantly, you can see that the level of compression over the last 2 to 3 weeks is really high. So you had a very narrow range, closed at the top of the range. Prices are neither overbought nor oversold. So the critical levels are the lows from last week, which are around 143 and the week before, and the recent highs. So there's enough compression in here to have a pretty good size move. However, the one caveat is on a weekly basis and on a monthly basis, you're running really quite rich here at around 99. Now, on these longer term charts, the weekly and the monthly charts, the RSIs are interesting, important to note, but things can remain overbought for weeks or months at a time. But the sell-offs at those levels are usually pretty sharp and significant, so it definitely takes merit. This is not the lower risk situation that we had earlier in the year or at the end of 2012. So again, on the weekly chart here, on the monthly chart, clearly in overbought regions. You can see we broke out of this wedge formation out to all-time new highs this month so far. So things are definitely in gear and looking rather well. Also, we are probably the strongest stock market out there right now. So that's a pretty good sign. Let's take a look at some of the market internals. The McClellan oscillator, right dab in the middle. That's more of an intermediate for swing trades or trades 1 to 3 to 4 weeks in duration. We are right in the middle, not overbought nor oversold. On the advanced decline and up-down volume on a 10-day, which is a shorter term reading, we're basically also right around neutral. Had worked off an overbought situation by going sideways. That, as we mentioned in earlier videos, is also a strong indication. So aside from some of that price movement on the longer term RSIs, the market internals definitely looking okay. Okay, let's take a look at our composite reading. So this is these two charts and the indicators on the bottom are a composite of about 22 different indicators, all weighted depending on the impact of each of the indicators in the appropriate time frame. So we look at a short-term market internals and a longer-term one, and that's what each of these charts in both the SPY and NASDAQ. Now, what's interesting is that we worked off, that overbought situation by going sideways, slightly down to sideways, and now we got some fresh buy signals at the end of this week. So overall, very strong market internals for the composite reading. This is both for the spiders and for NASDAQ. You can see right here we're sort of at the maximum reading for swing trades, the same thing in SPYs, and a little bit more moderate on a shorter term basis. So again, the overall picture very, very positive, with that one exception of some of the price momentum on the longer term charts sort of at its higher level. So it's clearly indicating that the risk is not where it was earlier in the year. We're already up, but the trend is still in gear. Let's take a look at some of the sentiment readings. Here's a sentiment. This is the VIX. This is the volatility. Again, looking at the daily charts, you can see we're trading right in the middle of the Bollinger Band. The key level here for us would be at around 16. which would take out the 200-day moving average as well as the upper end of the Bollinger Band, and that could signal a change in trend on one of the indicators. But meanwhile, we're firmly in bullish territory. We're clearly, where the 50-day is under the 200, we're trading under it and right smack in the middle of the Bollinger Band. So overall, that trend is positive, extremely positive, and sentiment is not overly frothy at the moment, because you can see we're sort of worked off from the bottom, and even at these levels, these price levels that the Dow and the S&P, the key indices, have hit, sentiment is not at an extreme level based on recent action. Gold. The key thing to remember here in gold is the weekly chart. The weekly chart, we have this critical trend line intact, still holding. So the intermediate trend on the weekly charts sort of still overall intact, although you can certainly say that the trend on the daily charts clearly down, starting to get into a warning phase on the weekly charts in gold. So the critical level to watch, and this would probably be a significant game changer, is a close under this trend line, and the recent and all of the closes going back to 2011 were all above, on a weekly basis, the 151 level. So that would be a clear sign. A close under 151 would definitely signal what I would call a trend change on an intermediate basis in gold, which is on the weekly charts. So critical level to watch right there in gold. Bonds, a little bit better performance than the gold. Again, you can see overall on the daily charts, the 50-day is under the 200, although we went into what would be considered a weak recovery phase. A weak recovery phase, here you have a declining 50-day moving average and sort of a weak breakout above it. So that's what I would consider a weak change, a weak upgrade in trend for the bonds. But overall, the deterioration is pretty evident. You got some pretty good resistance right up at that 120 level. The 122.50 is where the 200-day comes in, and some additional resistance from prior market action. So you really want to be cautious here, or be aggressive around this 117 level, which would be a change in phase under the 50-day moving average, a close under that 10-day moving average, the 50-day moving average, and this trend line that I just put in over here. So all of this coincides with, if you can close under that, certainly under the 117 level where all of this action occurred, you would be violating all this, and you would definitely be putting this market back under pressure, and the long-term trend in rates, which we think has been ended, would be strongly confirmed with that type of price action. Now, let's take a look at Russia, because I sort of highlighted that, and you know, they're definitely flexing their muscle. They want to get back on the world stage. They're doing everything possible on an economic basis, a military basis, even potentially knocking off potential political competitors is pretty brazen. So either they're very desperate or they're flexing their muscles because they can, and this indication here in the Russian stock market, clearly you can see Russia definitely underperforming the U.S. and other markets, but you've got this sideways action. So whenever the political events in the political arena and certain economic factors, cartels forming, things like that, you want to take notice. So what I would like to see is certainly a move back over the 65-week moving average, which is around 29 or so. Looking at the daily charts, a little bit of compression. You do have a rising 200, declining 50. We definitely need to see this thing up a bit before we get too interested. But longer term, I like to point these things out because that's where the big money's made. If you can catch one of these markets that are definitely beaten up and about ready to reverse, you can catch a very large-scale move as this market is basing out. So just want to point out, sort of similar with Vietnam, we had pointed that out earlier in the year, and that had a monster move right off the lows. Sort of similar type action in a sense. It was trading in a bearish phase, and it had a key reversal pattern around that 15 to 16 level and just rocketed off of it. It had a tremendous move. We caught the initial piece of this. So just keeping an eye on that Russian ETF. It's do not touch it yet. Look for confirmation, and we'll take a look at it when it starts to pick up its head in the future. All right, well, that's it for now. Don't forget to sign up for this newsletter at www.marketgauge.com, and hope you had a good holiday weekend, and see you next week, and bye for now.